So I just read an article on CNBC with a headline that reads, and I'm going to read it so I don't misquote it. It says, "Fed warns that a particularly large," that was in quotes in the article, "plunge in market prices is possible if risks materialize." So if that link doesn't, or that article title doesn't get your attention and cause you to click on it and read the entire article a couple of times, um, it should, right? When the Fed speaks, markets move, and there's a lot of things that can ripple, right? Real estate investing, at least for most of us, hinges on, getting long-term conservative debt. And the Fed is at the forefront of sort of moving that needle, if you will. So I thought I would share with you what I took away from that, because there's clearly a pull between the executive branch and the Fed, and who's independent and who hates who, and all that nonsense. So a couple of things that I took from the article. First off, there is a lot of market risk, right? Market risks is stuff that would impact everything, potentially. And the market risks that were highlighted, and frankly I agree with, are first and foremost trade tensions or geopolitical risks, right? There is noise and chatter and headline moving stuff seemingly daily or weekly, and that impacts everything. The stronger dollar is impacting things. It's real, right? And these things, I suspect there'll be good days and bad days. And what I mean by that is this is going to be one of those topics that say, hey, we have a handshake deal. Oh, no, we don't. Oh, yes, we do. Oh, no, we don't. And I expect this to go on for the next 2 years. And if anything, you know, I don't know if this will be true, but if anything, this will get resolved right before the next election. That's my guess. But in the end, we have to deal with what's going on today because it impacts things. So I think there's trade tensions and geopolitical stuff going on. It's all real. So the other one that was highlighted, and I may have to do a video on this, but I'm going to have to do some research first, is one of the market shocks they're referring to is companies issuing bonds. And it seems like the lower tiers, right, just above investment grade, seem to be ballooning, right? I wrote down a number, something like $3 trillion with a T, not a B. And that's, 35% of all markets. And this concerns me because what it kind of feels like for someone who has survived the 2008 crash is we saw subprime mortgages take off and go from being single digits, part of the market to over 30%. And that ended horribly. So I'm wondering, and again, I have to do some research, if these company bonds can have the kind of same disasterly effect. Do the bonds reset? Are they balloon payments? Do interest rates? I mean, just there's lots of stuff I have to unpack from that. But that seems to be one of the things that the Fed is really talking about. In the note, it actually goes on further to say that the banks are well capitalized, that individual borrowing is fine. It didn't balloon like last time. So it seems to be the risk is forming around companies. So what does that mean? Well, I think that means, unfortunately, the business cycle is real. So what's going to happen is as the business cycle turns, and we've had 10 years of relative growth, it's going to hurt. And there will be companies that have to reduce earnings, have to report lower revenue, have to then start cutting heads, and pretty soon their debt swallows them up. They can't service their debt, and either they go get a restructuring or they get sold for parts or pennies or whatever. So I think that's what the Fed's really highlighting is it's going to get bloody for companies because companies aren't going to be able to go out and raise anymore. But again, while it seems to be focused on companies, we all work, or most of us work in companies. So there's going to be some pain felt by the individuals as unemployment rises, as people are asked to take reduced salaries, all these things, right? So again, it's going to play out over a couple of years, I think. So it's time, really to start reducing expenses, time to grow your cash position and finally do what the rich do, and that's buy assets that are inflation protected, that are conservatively financed. So you have options if you need them going forward. So I think this is all going to get real. I think this is going to be an evolving story over time. But again, I guess the last thing to sort of point out is it's pretty clear that the Fed's going to raise rates in December and raise a couple more times next year, kind of regardless of what happens to the stock market. I think the Fed wants to flex its muscle being independent and doesn't like the shots or arrows coming from the executive branch. So it's going to be interesting. This is all people, and then all these decisions around us impact us all. So it should be interesting to watch. Have a great day.